Here at LPL Research, we watch and analyze a number of different markets to try to determine what markets are pricing in terms of, say, earnings expectations, default expectations, and even different economic scenarios. We believe in the wisdom of crowds, so to speak, because markets tend to move in advance of some of that hard data that would actually confirm a particular outcome. So in this edition of the LPL Street View, we take a look at a couple different fixed income markets to try and determine if markets are pricing in an imminent economic recession. The research team here at LPL is constantly watching markets, equity markets, interest rate markets, credit markets, commodities, etc. And as market watchers, we try to glean what markets are pricing in terms of the probability of certain events happening. And there are two very important markets within the fixed income markets when it comes to determining the expectations of an economic recession. Those are the U.S. Treasury market and the U.S. high yield corporate credit market. The shape of the U.S. Treasury yield curve is often looked at as a barometer for U.S. economic growth. More specifically, it reflects how the Federal Reserve intends to stimulate or slow economic growth by cutting or raising its policy rate. Now, in normal times, the yield curve is upward sloping, meaning longer maturity yields are higher than shorter maturity Treasury yields. However, when the economy is growing too quickly, inflationary pressures are apparent, and the Fed wants to slow growth, shorter maturity securities could eventually out-yield longer maturity securities, inverting the yield curve. And an inverted yield curve has been a pretty reliable predictor of economic recessions. And as we know, over the past 6 months, the Fed has been aggressively raising short-term interest rates in an effort to arrest these continued consumer price increases and to slow the economy. So when we look at the yield curve currently, we do see the 2-year yield is out-yielding the 10-year Treasury yield and is thus inverted. And that's the blue line we're showing here, which is just the difference between the 10-year Treasury yield and the 2-year Treasury yield. Maybe more concerning, though, is that the 3-month, 10-year part of the yield curve is getting close to inversion as well, and that's the orange line. And the 3-month, 10-year parts of the yield curve have more academic backing in terms of the signal that it provides. And as you can see on the chart, economic recessions have occurred shortly after these yield curve inversions have taken place, and that's the red highlighted part of the chart. So the signal that we're getting from the interest rate markets is maybe a recession is on the horizon. However, rarely do we only rely on one market as a definitive signal, so we next turn to the other important fixed income market, and that's the U.S. high yield corporate credit market. The U.S. high yield corporate credit market can, at times, act like a canary in the economic coal mine. The return distribution for high yield investors is asymmetrical, which means the potential for losses can be magnitudes larger than the potential for gains. So credit markets tend to react quickly when economic conditions start to deteriorate. And when we look at the signal coming from the high-yield corporate credit markets, we aren't seeing the same level of concern for an impending economic recession. Credit spreads, or that additional compensation for owning riskier debt than Treasury securities, have risen lately, but we haven't seen them rise to the same levels that previously signaled a recession was on the horizon. In fact, when we look at spreads currently, they're only back to that average level over the past 20 years. Spreads have tended to widen out to around, say, 700 basis points or so, whereas we're currently only around 460 basis points, which again is roughly the long-term average spread to treasuries. So what's the takeaway? When we have two slightly different market signals, we think it's best to listen to both, of course, but because we're getting different signals, we don't think markets are expecting a recession in the near term. That said, as the Fed continues its aggressive rate hiking campaign to stamp out these high inflation rates by deliberately slowing the economy, we do think recession risks have increased. We think a soft or softish landing is still possible, but right now we think it's a 50-50 proposition that a recession occurs sometime in 2023. But we'll be watching markets closely for signals that those risks change. Thanks for listening.